The ink is barely dry on the vellum-thick deed before the heavy oak doors of the bank close behind you, sealing the pact with a definitive, hollow thud. You walk out into the sunlight, clutching a folder of documents that weighs less than a pound but carries the gravitational pull of a collapsing star. You believe you have just achieved the apex of the modern dream. You believe you have purchased a home, a sanctuary, a slice of sovereignty carved out of the chaotic world. You envision the granite countertops, the manicured lawn, and the holidays hosted in a dining room that smells of pine and prosperity. But let us strip away the varnish of sentimentality and look at the architecture of the transaction with the cold, unblinking eye of a forensic accountant. You have not bought an asset. You have purchased a liability masquerading as wealth. You have not secured your freedom. You have voluntarily entered a gilded cage, locking the door from the inside and handing the key to a faceless institution that views you not as a human being, but as a yield-bearing instrument. To understand the true nature of the mortgage, one must first dissect the etymology of the word itself. It is derived from the Old French mort, meaning death, and gage, meaning pledge. A death pledge. It is a promise that dies only when the debt is fulfilled, or more grimly, when the debtor ceases to exist. This is not merely linguistic trivia. It is the foundational philosophy of the system you inhabit. When you sign those papers, you are pledging the prime decades of your life, your labor, your creativity, your time, to service a debt that is mathematically designed to keep you treading water while the currents of compound interest carry your wealth upstream to the vaults of the lending class. The architecture of debt is built on a very specific blueprint, one where the foundation is your ignorance and the spire is the bank's profit. Consider the amortization schedule, a document most borrowers glance at but rarely comprehend in its terrifying totality. In the early years of this 30-year sentence, the vast majority of your monthly tribute vanishes into the black hole of interest. You are not paying for the house. You are paying rent on the money you borrowed to pretend you own the house. You are effectively a tenant in a property you are responsible for maintaining, repairing, and insuring. If the roof leaks, the bank does not send a crew to fix it. That burden is yours. If the market collapses and the value of the structure disintegrates, the principal balance of the loan remains granite hard and immovable. The bank takes the security, you take the risk. This is the asymmetric warfare of modern finance, a game rigged so elegantly that the losers thank the winners for the privilege of playing. The illusion of ownership is the most potent narcotic in the arsenal of the elite. It pacifies the workforce. A man with a 30-year mortgage is a man who will not rock the boat. He will not resign from the job that crushes his soul because he cannot risk missing a payment. He will not demand radical change or take dangerous risks because the fear of foreclosure hangs over his head like a sword of Damocles. The mortgage is the modern equivalent of serfdom, binding the peasant to the land not by law, but by debt. It is a brilliant mechanism of social control, ensuring a steady supply of obedient labor to fuel the engines of corporate industry. You are anchored to a specific geography, limiting your mobility and your ability to seek better opportunities in a globalized marketplace. You have traded the agility of the sovereign individual for the static heaviness of the indebted consumer. Furthermore, let us examine the lie of equity. You are told that your home is your greatest investment, a piggy bank that you live inside. This is a half-truth that serves the sellers of real estate and the purveyors of debt. While it is true that real estate generally appreciates over long horizons, one must calculate the true cost of that appreciation. Calculate the interest paid over 30 years, often doubling the sticker price of the home. Add the property taxes, which are effectively rent paid to the government for the privilege of occupying your own land. Add the insurance premiums, the maintenance costs, the renovations required to keep the aesthetic current, and the inflation that erodes the purchasing power of the currency. When you run the numbers with the ruthlessness of a hedge fund manager, the return on investment is often negligible, if not negative. The S&P 500 does not require a new roof every 20 years. Gold bullion does not need to be painted. But the myth persists because it is essential to the economy that you keep buying, keep borrowing, and keep believing. The architecture of this debt is designed to be invisible. It is hidden behind the emotional veil of home. We are conditioned from childhood to equate the white picket fence with success. To rent is seen as transient, unstable, a failure to launch. To own is to arrive. But who truly owns the asset? Until the final penny is paid, the bank holds the deed. You hold the title, a piece of paper that grants you the right of possession subject to the lien. Try missing 3 payments and see how quickly the illusion of your ownership evaporates. Sheriff's deputies do not care about your memories or your sweat equity. They enforce the contract. The house is a gilded cage because it is adorned with the trappings of luxury and autonomy, yet the bars are forged from the ironclad terms of the promissory note. We must also look at the opportunity cost, a concept the wealthy understand intuitively and the poor ignore entirely. The down payment you scraped together represents capital that has been imprisoned in drywall and lumber. That capital could have been deployed into cash-flowing assets, businesses, or liquid investments that compound without the friction of property taxes and maintenance. By locking your liquidity into a primary residence, you are sterilizing your wealth. You are freezing it in a block of ice that thaws only when you sell or refinance, both of which incur significant transaction costs. The wealthy use real estate differently. They do not buy homes to store their wealth. They buy apartment complexes to extract rent from those who believe in the dream of homeownership. They use debt as leverage to acquire cash-flowing assets that pay the debt for them. You use debt to acquire a liability that you must pay for with your labor. The difference is subtle but catastrophic. The psychological toll of this arrangement cannot be overstated. The stress of the monthly nut, the looming threat of economic downturns, the golden handcuffs that keep you tethered to a cubicle, these are the invisible taxes of the mortgage. It narrows your horizon. It forces you to think in 30-day cycles, surviving from one statement to the next, rather than thinking in decades or generations. It turns you into a domestic animal, fed and sheltered, but ultimately domesticated and dependent on the system for survival. A sovereign asset is one that you control, one that generates freedom. A mortgage is an anti-sovereign asset, a mechanism that generates dependency. This is not to say that one should never buy a home. There are utility values to ownership, stability for a family, the freedom to renovate, the psychological comfort of a fixed abode. But one must strip away the romance and view the transaction as a consumption decision, not an investment strategy. You are consuming housing services. You are paying a premium for luxury and control. Do not confuse this with building an empire. The true empire builders are the ones issuing the mortgages, securitizing the debt, and selling it off to pension funds. They are the architects. You are the bricklayer who pays to build the wall that encloses you. The grandeur of the cage does not alter its function. Whether it is a penthouse overlooking the metropolis or a sprawling estate in the suburbs, if the bank holds the leverage, you are merely a custodian of their collateral. The marble floors are cold comfort when the market turns. The high ceilings offer little breathing room when the interest rates adjust or the property tax assessment spikes. You are living in a simulacrum of wealth, a stage set constructed on the credit of your future labor. To break free from this mental prison, you must shift your perspective. You must stop viewing the bank as a benefactor who granted you a loan and start viewing them as a vendor selling you a very expensive product. You must realize that the American dream, or the property ladder, are marketing slogans designed to manufacture demand for debt. True sovereignty comes from liquidity, from mobility, from the ownership of assets that do not require you to bleed cash every month to retain them. It comes from understanding that the roof over your head is a shelter, not a savings account. When you walk through the rooms of your mortgaged home, admire the craftsmanship, enjoy the shelter, but never forget the invisible architecture that surrounds you. The beams are made of wood, but the structure is held together by the promise of your servitude. It is a beautiful cage, gilded with your hopes and polished with your sweat, but it is a cage nonetheless. The door is unlocked only when you possess the capital to stand on your own, independent of the lender's grace. Until then, you are simply a highly paid caretaker of the bank's portfolio, living in the shadow of a debt that masquerades as a dream. Wake up. See the bars for what they are. Only then can you begin to plot your escape.